everybody. Welcome to Friday, another Talk Money with Tom show today. I want to thank everybody for coming and joining us. Our objective here is to answer your questions. We focus on retirement planning, how to manage your money during retirement, and how to avoid taxes or reduce taxes during retirement. And so any questions along those lines you can send to us now. We'll try to answer those live. Talk Money with Tom, ask Tom at talkmoneywithtom.com. Or you can put it into the chat if you'd like, obviously, and you can send these questions during the week. We answer questions that have come up from our client, strategy sessions too. So hopefully something will, ring with you, and you'll get something out of the show. We're big believers that education in these areas really helps out, even if you have an advisor. That's why we created this channel. And so you can subscribe to the channel. You can hit the little bell button and get notified when we put new content out. We're constantly doing new things. So. And then obviously you can meet with us if you'd like, just ask us some personal questions. You can go to our website, hit the book appointment button, and schedule time to meet with us, half hour with Ethan and I. So hopefully everybody gets something out of this show today. Really appreciate everybody joining us, and we've had a lot of great questions come in here too. And today there's some great questions today to I think to learn from as far as that goes. We always start off the week talking about the market for this for the week, and what was the summary and kind of what happened. And it was a pretty spectacular week, actually. Let me share the chart here for starters. We had a situation this week where one company has really kind of dominated this week, no doubt about it. And the market was kind of selling off, especially in the tech arena, for the kind of 3 to 7 trading days prior to NVIDIA's earnings release on Wednesday after hours. Yeah. And I think it's because NVIDIA has become so important as a bellwether for how well artificial intelligence is doing.
Yeah, it's the next hype cycle.
Yeah, and so how are things happening? How are how much revenue is coming in this arena, and is it still developing the way people are hoping and been talking about? And so the bar was set very, very high, in my opinion, on the expectations for their revenues, their earnings, their forward guidance. They crushed all three of those.
It was amazing.
By a lot. And so Thursday, of course, the S&P 500 was up 2.1%, hit an new all-time high. The NASDAQ 100 hit an all-time high. The Dow hit an all-time high on Thursday. So, it really drives the whole market at this point. The two main categories of, I think, concern or interest are, what's inflation going to do and how's the Fed respond to that? And then, of course, what's happening with artificial intelligence.
Yeah, it was crazy because Japan, which is their stock exchange, hasn't hit an all-time high in 34 years, based off just NVIDIA's earnings, and their semiconductor stocks were able to hit all-time high too.
Yeah, it launched kind of a worldwide rally. It's kind of amazing to see that from one company. Actually, I don't recall that happening that often, and how much importance people were putting into that particular earnings report. And forward guidance and such too. So I thought it was a really nice piece. It's really first quarter of last year, they announced their earnings, and it was a big surprise. And I think their stock jumped to over a couple of days of roughly 40%. And it was just a big number. But if you look at what happened with NVIDIA this time, I mean, they $22 billion in revenues for the fourth quarter of this year, or last year, sorry. They came up from $6 billion in revenues the previous year in 2022. That's a huge number. Their earnings were up 486%. And so even though their stock is up a lot, a couple 100% last year and a really good run this year, it still hasn't actually kept up with their earnings.
And another crazy part is that their expenses were very flat compared to how much their earnings or their revenue went up.
Yeah, their profitability is growing. The other thing that surprised me is they actually had a pretty good sized drop off in their sales to China via the restrictions that the U.S. is putting on, and they still crushed their numbers. I mean, without those restrictions, my goodness, they would have really went.
Yeah, they're still saying they're having problems keeping up their supply to meet demand.
Yeah, you said that this week. It's a good thing to hear. We can't keep up with the number of orders. If you're an investor, it's something you want, something you want to hear. And so, we don't spend a lot of time talking about one particular company, but it moved the whole market. We invest in the whole market. NVIDIA is now the third largest stock on the U.S. stock exchange,
Hmm.
fourth worldwide.
Yep.
And so, if you buy the S&P 500, it is a market cap weighted index. And so the bigger the company, the more impact it has on the growth of that index. And so, you own a sizable chunk of NVIDIA now that it's the third largest as far as that goes. Passed up Amazon, passed up Google. I don't know if it deserves to be as big as those companies. I look at Amazon, I look at how many different product lines they have, and their robustness. But nonetheless, this is the hype arena that we're dealing with as far as that goes. And so let's talk a little bit about NVIDIA and kind of some of the other cycles that we've been through like this. I mean, if you look at this chart, it's pretty incredible.
Hmm.
I mean, look at it go. It just continues to go. Again, this is 1995 to me. I've seen this before. I was very heavily involved with hundreds of clients and hundreds of millions of dollars in the 95 to 2000 run up. I remember very specifically a lot of pieces there. And I remember 95 because there were so many doubters. I mean, I have people come in and talk to me and say, oh, it's not going to last, and over. And you just keep seeing like, back then, ironically, we actually used the newspaper.
Hmm.
I mean, that was the dot-com bubble. It doesn't mean that we had the dot-com part really ingrained yet. But in 95, you get out the paper and they'd have, the listing for all the stocks. And you could just see it was a plus, 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 plus. I mean,
Yeah.
everything was plus, and the breadth was outstanding. And, it's something I hadn't really seen up until that point, even in my career. And so this type of vertical launch is a lot like that. And kind of what's happening here is reminding me of that. And just a quick take on what's happening with the Federal Reserve and the interest rates. I do think that motion right there, straight up, is easing financial conditions, and
Hmm.
people are going to spend more money because they feel like they have more money, even if it's just in their 401k. They're
Yep.
going to feel wealthier. It's a sign of the stronger economy and all these different types of things. And so, there is some potential threat that this is going to make inflation getting back down to 2% harder. We haven't seen any real evidence of that. If we look at PCE, core PCE inflation, it is, still doing what it's supposed to do and coming down. So, we'll have to see how that goes. But I do think that the Federal Reserve is going to fade from the picture to a certain degree. We won't be talking about it as much.
Hmm.
Unless inflation does pick up and they start to talk about actually raising rates. So
Yeah.
far, they're still saying, hey, we're going to lower rates. It's just later than the market says, right? I mean, that's the consensus. I mean, I've heard a lot of interviews, read a lot of articles. And so, I was saying this yesterday, but, we had an interview yesterday saying, hey, we're probably not going to raise rates for a lot later than you think as a market. And the market didn't care, because NVIDIA and the earnings and the AI is kind of now starting to dominate that. And I've said, I'm not sure they'll lower rates this year. I'm not even sure that's a bad thing. Usually it's dangerous because if they leave them up too long, it could cause, big recession at some point in the future. But if you have this kind of economic growth, and I think what you're seeing with NVIDIA is growth. You're
Hmm.
seeing the backbone of spending and what have you. Now, NVIDIA's big customers are the big seven,
Yeah.
and so, they've got more cash flow than most as far as that goes. But let's just talk about this from a cycle standpoint and kind of what you need to be aware of, because I've been here before. I've said this before. It starts off with the picks and shovels, right? That's
Yep.
what this is. The companies that are selling the things that kind of make it happen. So NVIDIA is selling chipsets, GPU chipsets that allow for fast data, analysis with artificial intelligence and what have you. And then it'll move into companies that we're not really talking about at this time, and then it'll move into the crazy companies that we shouldn't be talking about
Yep.
anyway, because they don't have any revenues. They shouldn't be going public, but they will be because that kind of mania is there. If the pattern is the same as the 2000 run up, that's what will be happening.
Yeah, you can. We saw this pattern also with social media.
Yeah.
How many companies went public
Yep.
or just without revenue or
Oh,
losing
yeah.
money.
Yeah, and not all of them survive, right? I mean, that's
Yeah.
yeah. So here's one that's been going around is a comparison between Cisco and NVIDIA. So Cisco was, there's some big differences between these two companies, believe me. But the one big commonality was they were both picks and shovel companies. They both had a situation where they were providing the resources for this particular arena. One would be the internet, and the other would be artificial intelligence in this case. But the chart looks kind of similar, right, and kind of peaking out. And so we'll talk about what you should be thinking about here if you happen to own this stock. But there's some pretty big differences. Number one is, NVIDIA is much larger. Cisco was sort of I wouldn't say a startup, but close, in that stage. Cisco was selling at 150 times earnings at its peak. We're now at around 60 something on NVIDIA. Cisco had developed the router. The couple that developed it did it at Stanford, but they were gone really fast, and venture capitalists took over. And most of their new development came from acquisitions and mergers, which they did really well. And then when that kind of slowed down, that really, Cisco's never really recovered from that. They got to $80 a share, dropped down to $8.60 at its lowest point, about a year and a half later. They were at 560 billion in market cap. They're short of 200 billion now, right? Yep. So they've never really recovered from that. Whereas NVIDIA is actually sort of reminds me a little bit of Intel. They're constantly developing, and in-house. They don't make them, right? But they design them. These chipsets, and also the thing that kind of strikes me about NVIDIA, they went from kind of gaming is a hot market for them to Bitcoin mining to now artificial intelligence. So they're being kind of agile too and moving through, I wouldn't call those completely different markets, but nonetheless doing quite well there. There's lots of threats that'll come from, outside competitors like AMD is developing a chipset that's supposed to be pretty good. And then of course their own clients, Meta, Microsoft, are trying to develop their own custom in-house chipsets. Also,
it gets expensive, and you're competing for product, and you can't buy enough. You're not going to want to buy it.
Now, here, the reason we're talking about this, we don't have NVIDIA in our portfolio on an individual basis. Some clients have it because they had it from before, but it's important to understand that one company can go through a cycle, right? It doesn't mean that your entire portfolio is going to go through a cycle, and it doesn't mean the whole market's going to go through a cycle. It's one of the reasons we really believe in these big baskets of stocks, is to kind of diversify into different pieces as far as that goes, so that you can kind of go through if NVIDIA does have some type of a downturn as far as that goes. So here's what you were talking about earlier, this hype cycle, right? I really think understanding this market curve is really going to be important now, okay? Because you have to be careful here. I remember very specifically, basically humans, and the stock market is a representation of human emotion. And humans have this tendency to take a chart and just add to it whichever direction it's going, really into infinity, whether that's up or down. And so, but there is a cycle to this. And so what happens is the markets continue to run and run and run. And right now we're probably, I would say, in this hype cycle. The dot-com run was 5 years, right? The internet might shorten that, right? It seems to me that things move a little faster. Maybe this is a 2.5 to 3 year run. We're already a year into it, a little over a year into it. But this is the reason I'm saying, at least from a standard standpoint of how these cycles work, that we're not at the end, or maybe not even halfway, is only because we don't have the other craziness that comes along, right? I always tell a story about bingo.com, as this was at the end of the hype cycle for the .com, and the internet craze. Company goes public, they go from $1 to like $9 a share. Client calls up, wants to buy. I look into it. They didn't even have approval to do bingo. And it was a Florida-based company that just disappeared in the end, right? Because they didn't have revenues. They didn't even have a product, essentially. But that's the type of thing we saw. I'll never forget, there was one company that was actually a .com company, and they put .com in their name, and their stock went up 36% that day. I was like, okay. So that's the type of stuff we haven't seen yet. But once we start seeing that, you were telling me about Supermicro, which is a legitimate company with good revenues, good business, but they've had what, a couple 30% runs, you know?
Yeah, essentially, they're kind of NVIDIA's partner with AI chips
Yeah,
or data centers, and Supermicro is kind of leading the edge on data centers with liquid cooling,
mhm.
which is because AI chips run so much hotter and draw so much more power that you need more advanced cooling, and so Supermicro is kind of leading that forefront. And so, just on NVIDIA's data yesterday, Supermicro jumped 30%, and
Yeah,
so in the last, if you were to buy them a year ago or the beginning of 2020 or 2022, you would have gone about 900% of gains just on that. Yeah.
yeah, and yeah, you know, again, sort of a picks and shovel
Yeah.
company, really, at this point in time, and a good spot for that. But we start to hear some of these things, you know, just kind of register them and try to figure out where we are in this hype cycle. I don't think we're even halfway through, but you know, honestly, anything can interrupt these cycles.
Hmm.
Something major, you know, Taiwan and China conflicts, or you know, whatever can happen, can definitely change these. Federal Reserve starts going crazy and starts raising rates a lot because inflation's getting out of control, could really put a
Yeah.
dent in. So, you know, be cautious with what we're talking about. We're talking in general terms, but then basically you'll end up kind of, you know, the facing reality. You know, hey, they don't actually have a license to do bingo. The company goes out of business. Hey, this company doesn't actually have revenue. I remember the SPACs. Remember? Oh my gosh.
Oh, yeah.
Yeah, there was one that was just we were talking about today on Bloomberg Radio on the way in. You know, it's dropped by 75%. You know, and that's the type of, so when you start hearing those types of things, just stand back and say, okay, you know, we're heading for some topping motion
You
here.
can think of all the meme stocks too. They
Yes.
all, had this hype cycle and
Right.
now they're all facing reality.
Right.
Some
Yeah.
of them will probably make it out of
Right.
this, but some might not.
Yeah, and so the actual, you know, ultimate market opportunity, right? The liftoff, that's the big piece. And you know, that's where Amazon came from, and that's where the companies that are using, and back in the dot com, you know, the companies that are actively using the internet to market and cut costs and create
Mhm.
efficiencies, you know, they start creating higher and higher, you know, earnings per share. So that'll be here with artificial intelligence. That, you know, be some actual artificial intelligence companies that come out of this. That'll be the Amazons of that arena, and then you'll end up with a lot of companies making money, more money than they would have by using those products, and then it kind of levels off. And so, you know, we're in that hype cycle, and so just to kind of point out, once you take off the Chiron there, there we go. This is a really long chart. This is a monthly data point
Mhm.
chart, right? This is going back to the early 1900s. And so we had the, you know, the roaring 20s, which came after the pandemic. And it really, you know, there was a lot of interesting things in there. They had 90%, you know, margin, you know, you had to
Yeah.
have 10% down, and you know, all these things that happened. Tremendous run up. So you could have made money in that, but if you stuck with it all the way through, the market dropped 87%, right, and kind of fell below, you know, where it started. Little different. If you look at the .com arena, it didn't fall below where it started. So that second circle there from 95 to 2000, from 95 to the end of 99, really. So that's the best 5 years in the history of the stock market, but it still had a 45% drop,
Yeah.
right? So what you want to do here, I remember in 2021, in February 2021, we moved our clients out of the market to our 20% stock exposure portfolio. Market dropped a little over 20% that year, and we came down a couple percent in that portfolio. And so you just have to kind of have some thought process here for what is going to happen and how this might transpire. You can ride this. And so I'm not a big fan of taking profits as you go. I remember, you know, I had relatives, my sister and whatnot, working at Cisco, and one of the managers had liquidated early on, you know, $50,000 to buy a Mercedes. This is back when you could buy one for 50,000. And, you know, they used to call it his $1 million Mercedes because, you know, the stock ended up being worth roughly $1 million that he sold. And so, you know, you do need to kind of let your winners run, but should have some type of a stop loss system sort of in place. So when things start to truly deteriorate, I'm not talking about like the 10% drop that we just
Yeah.
had, you know, last year, you know, kind of bigger than that. So that you're not, you know, I mean, Cisco's a good example. It went from 80 to $8 or $9 basically. And so if you had, let's say, a 25% stop loss in there, you didn't get the top, but you didn't suffer 90% drop either. And so you keep some of your profits that way.
Yeah, you can think of it also like Bitcoin.
Yeah.
There's like someone that paid 10,000 Bitcoin for a pizza.
Oh, yeah, that was probably expensive pizza.
Yeah, that when you think about it, Bitcoin's what around $50,000 now.
Yeah.
So, but so
Gold plated.
yeah, so but if you just sold a portion of it because how volatile Bitcoin is, you'd still have some.
Yeah, there's nothing wrong with taking small pieces off and what have you as you go, but don't be afraid of the run because I get a lot of people that are afraid of the run, and they just think it's going to, just completely fall apart, which it might, but it can run a lot longer than you think, and so you have to let that run and get your profits. This is how we make money in the market is by letting our winners runs and cutting our losses short, right? Now, I'm not a day trader. I'm not cutting them at some small number. I might, cut them at 20% or something like that. But anyway, that's the concept. I think that's important to understand when you're looking at, this particular market, because it seems to be, especially with this earnings report, it just kind of solidifies even more kind of the thought process that you and I have been talking about, which is just, this cycle with the combination of the pandemic pent-up demand and the artificial intelligence has been very, very powerful, right? I mean, so we're seeing this motion. So enjoy that, ride that, figure out how to, maximize that, and then just be ready and watch the signs for what might be happening as this cycle starts to develop. Again, it's a representation of human emotion. It won't be a straight line, but there are some common pieces that have happened throughout time in these kind of hype cycles and these mania cycles. Tulip mania is from the 1600s, I think. So this has been going on for a long time, and as a crowd, we really can kind of go crazy one way or another as far as that goes. So, but great week, great time to be an investor. Really good time to be in the market with the right pieces right now, and kind of letting our wins ride. Lots of momentum here. Don't be afraid of that momentum. I don't think it's going to change anytime soon, unless there's some big outside influence that comes in and changes things. But pretty exciting altogether. So anyway, that's our summary for this week. We actually won't be here next week doing the show. But I will be doing the summary, just do a quick summary and send that out and post that on the channel. So look forward to, doing that again next week. So, all right. So what do we have for our first question?
What are your thoughts on using the Guyton guardrails as a distribution strategy versus like the straight 4% rule? Do you have a different withdrawal strategy that you prefer?
Yeah, so this came in during the week. I think it's a really interesting concept. Not a lot of people know about it as far as that goes. I'll share a chart that we found. I think that will do a good job of kind of describing, at least somewhat so, how it works. So essentially the question revolves around how do I withdraw money from my assets to live off of during my retirement, right? And it's a really good question because it's a very important area. Which assets you withdraw from first, sequence of withdrawals is a huge deal. This has to do with kind of on a percentage basis, how much should I be taking out?
Because your portfolio doesn't go up in a straight line or go down.
That's right. And so how do you adjust for good and bad markets and really for inflation too? Because, if you take out $1,000 a month today and 20 years from now, it's not going to buy you nearly what it does today. Yeah. So, there has to be some increase there to keep your standard of living at the same level. So you have, if you look at that green line, you have initial WR, withdrawal rate, right? So let's just say, again, it's around 5%, which is what they talk about for this particular.
Yeah, they say 5.2 to 5.6,
yeah,
which is much higher than what the world's talked about, how a 4% is kind of that straight 4% is this.
Right. And there's been a lot of attacks on the 4%, and rightfully so, as far as that goes. And so this is an adjusting concept. Let's say you start off at 5, you would continue to increase your amount of withdrawal by inflation. And what they're talking about is using CPI. You look at CPI. CPI was up 3%. And so I'm going to increase my withdrawal by 3%. Yep. Right. So if I'm taking out $100, I'm going to take out $103, that type of thing. But then you want to monitor the overall percentage of withdrawal that you're doing. And so let's say, for example, the market comes down and you're taking out that, $100. And now all of a sudden it's 6% of the
Yep.
portfolio. And so that's where they're showing that first arrow there, that upper guardrail.
So the guardrails are 20% higher or lower than the
Right.
initial withdrawal rate.
So in this case, it'd be plus or minus 1%,
Yeah.
right? So 5 in the middle, 4 at the bottom, and 6 at the top. And so what's happening here, it gets to 6, you would want to drop it back down and reduce your payment by 10% of your withdrawal.
Yeah, so
Right.
if you're taking $4,000 a month, you drop it by $400 and you'd only be taking $3,600.
That's right. And then the opposite happens. Let's say the market, and again, you're still increasing your amount by inflation on a regular basis, but the market does so well, your accounts do so well, your advisor is really good and makes you more money than expected. And all of a sudden now you're only withdrawing 4%. Even with those cost of living increases, you have a 4% withdrawal that's happening. You can then jump that back up. So if I'm taking out 4,000, I could take out 4,400.
Yeah, so the idea is that it fluctuates kind of with your portfolio size and your withdrawal rate.
Yeah. And so just to compare that with kind of how we do it, is just simply, we have a portfolio. We put enough money in the money market for 3 to 6 months. We have sleeves inside that portfolio that are all based on momentum. We're moving into the things that are moving, and we have a very strong algorithm and a back testing that we're doing on a constant basis to figure out what those are. And then we replenish the money market, when the money starts to go out for the distribution. And we'll most years do a rebalance of the portfolio to get back to our target percentages, for each one of the sleeves once a year, right? And then what we do to figure out whether or not that withdrawal is appropriate is we use Monte Carlo simulation. So we'll go in and run their financial plan, which includes everything, right? Social Security, their pensions, their rental incomes, all of their assets, all of their outflows. And we will run that and say, okay, as long as your withdrawal rate is at 85% or better success rate, right? We're okay. And so market drops and somebody's at 90 and they drop back to 82%. The idea would be they would pull back on their withdrawal rate so that they're still in that 85% realm. Here's the one thing that's very, very interesting. Two things, I guess. Number one is an awful lot of our clients are in that 99% range.
Yep.
And the reason is, which means they could spend more.
Yep.
But they don't want to. That's how they got the money. And it's really fascinating. So their lifestyle is less than their money can accommodate. That's a saver.
Yep.
That should be the definition of a saver. And so they're at 99. We run their plan. The market's falling apart or whatever. And now they're at 90. Don't really need to make an adjustment because our upper boundary would be 85%, probability of success. And so that's one way to do it, is to have, a lifestyle. I've read that many times, always have the ability to save some money, even in retirement. And I've got a lot of clients that have done that. And I have a hard time convincing a lot of my clients that they can spend more money because they just, if they were going to spend $10,000 on travel, they could spend 25, but they literally wouldn't enjoy the travel knowing that they spent that much, if that makes sense, even though they could easily afford it. And that's how they got the money, right? And that's the interesting thing. And so it's a different strategy than this. The other part, I guess the other point is that those few times that we've had situation where somebody's really withdrawing more than they should, I can't remember a time when I've been able to convince somebody to cut back.
Yeah, it's really hard to change your standard of living to decrease it. That's why a lot of people talk about how if you stop inflation or lifestyle creep, you're often in a better place because you're starting from a lower base.
Yeah, keep your expenses well below your assets capabilities, and you might not have to cut back. That's what I've seen within my clientele. Now, I'm not saying that you can't do this. As an individual person, as a do-it-yourselfer, I would say especially kind of an engineering mentality and you've bought into the process, and you look at this and you say, okay, when I get to 6%, I'm going to cut back, and I'm ready for that, and I'm keeping track of that. Uh, I could do it personally. I think, just knowing this is the plan, this is how it works. And especially once you cut off your income, right?
Yep.
You're no longer working, and knowing that you have something like this in the background, and even if it does impinge your standard of living for some period of time, markets generally go up over the long time. You're probably going to see that money come back, and you just should be ready for that, if that
Yeah,
makes sense.
so like it may be like I have to skip my vacation budget for this year.
Yeah.
And so as long as you understand and can keep to the guardrails, I think this is a good system because it allows you more spending power in a sense compared to just a 4% rule. I think the 4% rule is great if you're just doing napkin math. If you're saying, hey, I just want to figure out what's a rough number I want to have, that's good. I think this rule is fine, but I think a plan is just a little bit more in detail. So
Yeah, I think a plan's more robust, right? Takes into account everything, and really shows you the upper limit of what you could be spending, versus what you are spending, that type of thing. And so, yeah, I think that's
because this plan, the idea is that you won't run out of money after 30 years. That's their measure of success. But if you have, you're getting mass majority of your income just from pensions, is it okay then to be a little bit more aggressive with your withdrawal rate?
Yeah, exactly. So there's a lot of different ways to do it. I do think this would be hard to do on a practice basis when you're dealing with 300 different households and what have you, and tracking these. What we do, I think, works really well. We monitor the cash levels, we monitor the portfolios, replacement for momentum, we rebalance, we run these Monte Carlo simulations. The plan is live, everything's linked in. Basically just push a button and we can tell where somebody is pretty quickly, actually. So from a standpoint of monitoring hundreds of households, this would be, to me, it looks a little bit more difficult. The software that we have works really well for what we're trying to do. I'm not familiar with the software that you would use to do this. I'm sure there's something out there.
I'm sure it's been around long enough that someone's developed software that they could integrate into practice. So I think that having this is fine, as long as I think you have to stick to the plan. It's sticking to the plan is a little bit harder. We like this concept that you don't have to decrease your standard of living.
Right.
But if you're able to do that, then this plan works great.
Yeah, no, it's a great question. Thank you for sending it in.
When do you take profits and enjoy some of the returns? I have individual stock that has run, and now it makes up 25% of my portfolio.
Okay, so let's talk about NVIDIA as an example, right? And because I've actually have some scenarios we're working on with NVIDIA right now with some people that work there. And so I guess the first thing I would say is, how much is it, right?
Yeah.
Is it 20,000 or 3 million or something? I mean, obviously they're saying 25% of net worth, so we'll assume that's pretty big, right? And at least it's important, no doubt.
It makes a difference.
Yeah, and so really, I look back at look at Cisco and look at what happened there. Maybe that doesn't happen to NVIDIA, but it's been definitely a hard hit in this hype cycle. It's really going. And so, personally, I would have a 25% trailing stop. So, Cisco lost 90%. I'm willing to give up 25, so I don't have to sell it today and let it run. I want to let my winners run. That's a huge deal. You want to create wealth, you got to let your winners run, and whatnot. So that's one concept. Now, it depends on your tax situation. So I have $3 million. I put a 25% stop loss on it. I could get a massive tax hit. I would not be interested in that. So again, depending on the size, what your thought process is, and where you are with it, you might want to do what we call the fruit tree concept, right? And so what you want to do there is you would pick a dollar amount that you want to keep NVIDIA, in this case, or whatever stock it is, at. So let's say I have 2.6 million, right? And I decide that my tree amount, right, is 2 million. So every time it gets above 2 million, I'm going to prune, I'm going to take some fruit
Yeah.
off the tree. And so this thing can keep producing and producing and producing really for a long time. And I'm going to take that fruit, I'm going to pay some tax potentially if it's outside of a retirement plan. And I'm going to, put it in a diversified portfolio, outside of, just this one stock. And however, so now if I say my tree is 2 million, I have 2.6 million, I'm looking at selling 600,000. I'm still probably going to put in a tight stop loss on that 600,000 if I can. So like a 10% stop loss. Because maybe it turns into 700 or 800 or 900,000 before it finally trips 10%.
Yep.
I want a trailing stop loss. I want it to continue to move up with the stock from the high point, right? And so again, the concept here is I want to let my winners run and still be able to kind of take this. So all of a sudden it's worth 800,000 more than my tree of 2 million, 2.8 million. Boom, it trips, and I'm getting out with, more than 600,000 that I originally was looking at. Yes, I'm going to pay taxes, but I'm going to diversify. Now you want to look at that on some regular basis, monthly, quarterly, annual, whatever it is that makes you comfortable as far as that goes in terms of doing this, tree, picking the fruit off the tree. I think that's a kind of a good middle ground to doing that. Now, I have clients that, over the years, different advisors have approached them and said, oh, sell this or sell that, it's a company that they worked at. And some of those stocks are worth 10 to $20 million now. I'm really, really glad they didn't listen to that. And so it depends. If your situation is such that you can afford to, let this thing run, kind of unfettered. I had a client that put 14,000 in Apple's worth over $3 million. There's a lot of downturns in there that they could have sold out on, but just kept it. Didn't matter to them in terms of didn't need it right now. However, you can see Cisco's kind of like a dead 2 decades, basically, where, it hasn't gotten back to where it was before. So, there are some middle grounds in there to take a look at and whatnot. It's hard to tell when a company is just in the middle of its run or the end of its run, but I do like to see some weakness first, and that's why I prefer kind of a stop loss to kind of a pruning off the top, because you'll end up, potentially taking some money off that could have been worth a lot more. Try to maximize your runs. It's really easy to lose money. It's very difficult to make money.
Yeah. And also the thing about it is, what do you mean by enjoying your returns? Like, what size is that?
Yeah.
So, like, if you're saying, hey, I made $300,000 off NVIDIA in the last day, I'm going to sell $5,000 and take a vacation.
Yeah. Nothing wrong with that whatsoever.
It's like, it depends on the magnitude. What are you enjoying? Like, okay, I'm buying a $5,000 house. Maybe then you kind of, how much are we taking then? And you evaluate
That's
based on.
a cheap house.
Vacation house. Let's go with that. You can buy them somewhere else.
Airbnb. No, exactly right. I mean, you're talking about selling 300,000 or 200,000 of that gain. That's a little bit different because that could be worth $1 million if you let it run. And obviously you got to pay taxes on it right now. So I would just try to protect the gains and let it run as much as possible.
Yeah, it depends on where you are in your life too. If you're in retirement, you're retirement stable and your portfolio can handle it, maybe you do sell some and enjoy the returns.
Yeah, exactly. Yeah, it's a good question. I really like it.
So I have a house in California with a 2.75% mortgage. I'm moving out of state to be closer to my family. Do I sell or do I rent in the current market? The house would make a net positive return on rent or after the mortgage and expenses, just management expenses and general house upkeep.
So if you're going to make a profit on the rent and you've got a really low interest rate, that it might be historic. 2.75 might not see that again ever. So that's a unique situation. California real estate as a whole, not everywhere, has done quite well. So if you hold on to it for 10 or 20 years, that could be worth more, right? At some point in time in the future. So you can sell it later if you need to, maybe for more. And if you don't sell it, you don't end up with the capital gain potentially. You might not have one in that case, but theoretically, if you're positive cash flow, you probably have something in the way of equity. You do get your exclusion, right? So that is one of the pieces that you brought up when we were talking about this question was that, you get 250,000 each that you don't have to pay taxes
Yeah,
on.
and you only have to live in that house. It only has to be your primary residence for 2 of the last 5 years.
Yeah. So once you get past that point, now you don't have that exclusion anymore. So you do have to you could rent for a while and then see what happens. So, because your primary residence is now this new place that you've moved
Yeah,
to, where you get that exclusion. Um, so, so I would say, renting the place makes some sense. However, that is assuming you have enough money.
yeah. What is your opportunity cost by not selling?
Yeah, you're going to go buy another place, and you're either going to pay cash or you're going to have cash and a mortgage. And in both cases, you're giving up something. That cash could be invested in the market. Maybe
Yeah,
you could have, a 6% or more mortgage if you end up with a mortgage on the new place. And so that's kind of your cost on the other side for renting and not selling, assuming you could sell, capture more cash even after capital gains, and use that to pay for or pay down the mortgage on the new place. So there's a few pieces there that I think are missing in the information. You'd kind of need to know the full picture to kind of run the numbers to figure
yeah.
out what
Because
would
like,
really work.
let's say you're moving from California to a lower cost of area, and your net positive cash flow from your this rental pays the mortgage of the new place. Okay, so you're kind of break even there.
That's pretty good. Yeah, I'd vote for that. Yeah, because we have a lot of clients that have done that actually, that have kept a property and have done really well with it actually. Most people can't afford to do it
Yeah,
because it's a lot of capital sitting there, and then having to take more capital to go buy another place. Or maybe we don't have too many clients renting, places, if they moved near their kids and rented, that's pretty uncommon. Most times they're buying something. And a lot of times they are moving to a cheaper area just because, we are more expensive here than
yeah,
some places. So anyway, that's a good question. I would probably keep the place, in California if I could, avoid the taxes. When somebody passes away, there is a step-up basis,
yeah,
and so that's another advantage to keeping it. You could avoid the taxes completely by just renting it until somebody, passes away. Could be you if you're the sole owner, and maybe your beneficiaries get advantage of that, or your spouse. I think it's a big penalty to pay, but the step-up is, it's there. It's something that should be considered as part of the calculation.
yeah,
So I moved to Tennessee. I got a cheaper place. I have enough money to buy that place, and maybe I have a small mortgage, but I have enough cash flow coming from my California place. My cash flow could continue to increase with the rate of inflation, which is normal for rents in most cases. And then hopefully I get some appreciation, and then maybe I can get a step up also. If I
yeah.
want to sell it, that might be a better time to do it. That makes sense. So part of that does depend on what kind of gain you have over and above the exclusion and cost basis,
Hmm.
right? So anyway, good questions. Everything's a bit more complicated. I always get asked questions at like a party or whatever, and people just want, that like the 4% rule we were
Yeah,
talking
something
about.
that's super easy that you can just throw on a
It
napkin.
comes up all the time. It's how much can I withdraw? Like, oh my gosh, we run Monte Carlo simulations where we run it 1,000 times to try to figure that out. And generic things are generally dangerous,
Hmm.
so I try to be really careful. But unfortunately, on this show, we do get some generic pieces. So be careful. You want to evaluate all of the parts of your unique scenario to make sure that you're getting the right answer, and so that you're doing the right things as far as that goes. So. Okay, well, that's our show for today. I really appreciate everybody coming today. Great questions. I think these are some really in-depth questions today. I really enjoyed this. And again, we won't be here next week for the show, but I will do the summary next week, and so we'll have that. But anyway, we'll see you in a couple weeks. All right. Thank you very much.